Ladies and gentlemen, welcome to the land of finance. I recommend that you stop whatever you are doing right now. Stop glancing at the charts and listen to this video very carefully, because everything we thought we knew about this market, that entire narrative of people versus banks, has just been proven completely wrong. For 15 years, we told ourselves a very different story. We said the bullion banks led by JP Morgan were the villains. We believed they were trapped in a massive naked short position. We thought that when silver was finally set free, as it is today, when it hit $79, they would be wiped out. We thought we had squeezed them. We thought we had bankrupted them. We thought this rally was their funeral. We were wrong. We weren't squeezing them. They were waiting for us. We have just received intelligence that completely rewrites the history of the silver market from the ground up. According to newly emerging data from the deep records of COMEX warehouse receipts and vault holdings, JP Morgan was not caught in this rally. They were not crushed by the price explosion. They orchestrated this rally. According to this data, JP Morgan didn't just close that famous short position we were all obsessed with. They completely flipped the board. They are not short. They are net long, and they are not just a little long. JP Morgan is currently sitting on an accumulation of approximately 750 million ounces of physical silver. Let that number sink into your bones. 750 million ounces. This is the largest private physical silver hoard in human history. It is larger than what the Hunt brothers held in 1980. It is even larger than the custodial holdings of the SLV which they effectively control. That amount represents roughly 62.5% of annual global mining supply. Imagine what that means. For the last decade, while we were shouting manipulation and filing complaints with the CFTC, JP Morgan was quietly and systematically parking the truck in front of the mine. Every time they pushed the price down with paper contracts, it wasn't to save the dollar. It wasn't to help the Fed. They were doing it to buy physical metal at a discount. They suppressed the price using paper leverage, allowing them to accumulate the real asset for next to nothing. And now the accumulation phase is over. The metal is in their hands, 750 million ounces. And if you own 750 million ounces of an asset, what do you want the price to do? Go down? Of course not. Go up. This means the world's biggest silverback isn't a Reddit forum. It isn't a billionaire tech CEO. It's the very bank we thought we were fighting. JP Morgan has officially cornered the global silver market. They successfully executed the longest, most complex, and most profitable bait and switch in financial history. While convincing the world they were bears, they held one of the most bullish positions on the planet. While convincing the world they were bearish, they became the most bullish holder on Earth. And that explains everything. It explains why they stopped the rally at $30. It explains why they allowed it to go to $50. It explains why they allowed it to rip to $79 today. They are not losing money on this move. On the contrary, they are making a fortune. Every $1 move in silver adds $750 million to their balance sheet. The move from 30 to 79 did not hurt them. It generated roughly $36 billion in unrealized gains. This is a great betrayal. They sold out the other banks. They sold out the shorts that followed them. They left the smaller banks, Scotiabank, HSBC, holding the bag. JP Morgan exited the burning building years ago, locked the door from the outside, and now stands across the street selling water to the fire department. We are no longer fighting JP Morgan. In a twisted and ironic way, we are now on the same side. We want $100 silver because we want the truth. They want $100 silver because they want profit. But the destination is the same. And when the largest bank in the United States decides an asset will be repriced, that asset gets repriced. They have the capital, they have political protection, and now they also have the physical inventory to make it happen. But to understand how they did this, how they accumulated nearly 1 billion ounces of silver without alerting the market, we have to go back to the beginning. We have to look at where it all started, because this was not a plan created last year. This was a plan set in motion in the darkest days of the 2008 financial crisis. This was a 15-year scheme that began with a bank called Bear Stearns. Most of you know Bear Stearns as the first domino to fall in 2008. But you probably don't know why they fell, or what J.P. Morgan found when it bought the wreckage for $2 a share. Bear Stearns was the original naked short monster. They were the ones trying to kill silver. And when J.P. Morgan acquired them, they bought a toxic landfill of short positions. At the time, everyone thought it was a mistake. Everyone believed J.P. Morgan was doing the Fed a favor by swallowing that poison pill. But Jamie Dimon doesn't do favors. He makes deals. He looked at that massive short position and saw an opportunity. He saw that the short position gave him control. He saw that it gave him the power to set the price. And if you can set the price, you can control the flow of physical metal. So instead of closing Bear Stearns' shorts, he preserved them, fed them, grew them, used them as a weapon. For 15 years, whenever physical demand began to rise, J.P. Morgan dumped Bear Stearns shorts into the market, crashing the paper price. Weak hands sold. Miners panicked. And who collected the physical metal falling out of the market? J.P. Morgan. They built a massive vault in London, expanded COMEX warehouses, became the custodian of SLV. They turned into a vacuum cleaner, sucking in every free ounce of silver on the planet, and they financed it with the profits from their short positions. It was a perfect crime. The victims, miners and retail investors, paid for their own destruction. We paid for the vault J.P. Morgan built. But every game has an ending. And the ending of this game was triggered by the one thing J.P. Morgan couldn't control: geology. They knew the mines were drying up. They saw the deficit data before we ever did. They knew that one day physical scarcity would become so severe that even paper shorts couldn't cap the price. So they set a target. The decision was made to turn the key. According to the data we're seeing, that key was turned in late 2025. Somewhere between June and October of this year, J.P. Morgan quietly ended its last naked shorts. They went to zero. Then they went long. They took their foot off the brake and slammed the accelerator. And that is exactly why we are seeing this vertical move. The suppression machine was turned off because the operator left the control room. Now we need to look at the math of their position, because 750 million ounces is an impossible number to visualize. Let's put it into perspective. The entire registered inventory of COMEX, the metal meant to back the entire futures market, is currently around 30 million ounces. J.P. Morgan owns 25 times more silver than COMEX. They are the market. If they decided to demand delivery on their own long positions, they could break the exchange before lunch, but they don't need to break it. They already own it. What they need is a desperate buyer willing to pay any price to get their hands on that pile, and this is where the brilliance of their timing becomes clear. They didn't accumulate this metal to sit on it like a dragon. They accumulated it to sell, but not to us, not to retail investors, to a much bigger fish. They are waiting for industrial panic. They know the solar industry is exploding. They know electric vehicles are taking over. And most importantly, they knew about China. This brings us to the geopolitical layer of this betrayal. Do you really think it's a coincidence that China announced its export licensing ban right after J.P. Morgan finished accumulating? Do you think the most connected bank in the world didn't know Beijing was about to lock the doors? Of course they knew. They positioned themselves in front of the train. They knew that on January 1st, 2026, global silver supply would be cut in half by a Chinese blockade. They knew Tesla, Apple, and Samsung would be cut off from their Asian suppliers. And they knew there would be nowhere else to turn, except J.P. Morgan. When Elon Musk tweeted, "This is not good," J.P. Morgan smiled, because they have the solution to his problem, the 750 million ounces he needs. But that solution is not priced at $79. The price is whatever JP Morgan says it is. This is the pincer move. China restricts demand in the East. JP Morgan restricts supply in the West by hoarding it. The industrial user is crushed in the middle. The market is effectively cornered by two entities, the Chinese Communist Party and Jamie Dimon. And if you are a buyer of silver, you have to pay tolls to one of them. This turns our $100 target from a possibility into a necessity. JP Morgan didn't accumulate this position for a 10% gain over 15 years. They want a 10 times return. They want a price that justifies more than a decade of work. They look at gold, $4,500. They look at their silver hoard. They know that historically silver should be priced at 1/115th of gold. That puts silver at $300. That was the target. They have the inventory to withhold supply until the market delivers it. So the short squeeze narrative is dead. This is now a cornered market narrative. A short squeeze is chaotic and fast. A cornered market is controlled and deliberate. JP Morgan will walk the price up step by step. They will squeeze industrial users until they scream. They will extract every ounce of value from the technology sector. And for us, retail investors, this is the best possible news. We are no longer swimming against the current. We are being dragged behind a nuclear submarine. The bank that suppressed us is now incentivized to enrich us. But you must understand how ruthless their game is. They don't care about us. If they can, they will shake us out too. They will create volatility to take our ounces. But if we can hold, if we refuse to sell, then we sell at the same price they sell at. We stand alongside the largest whale in the ocean against industrial panic. The 750 million ounce hoard is the floor. It is the ultimate guarantee against a price collapse. Because JP Morgan will never allow its own balance sheet to implode. Alongside the Fed put, they've placed a JP Morgan put under the silver price. And this brings us to the victims of this plan. If JP Morgan is winning, someone is losing. The losers are the industrial companies asleep at the wheel, the tech giants who believed the lie of transitory inflation, companies like Tesla and Apple, who are just now realizing that their most critical raw material is in the hands of a bank that wants to squeeze them. In the next part of this report, I want to examine the trap these industrial victims have fallen into in detail. We need to talk about what happened when Elon Musk called Jamie Dimon. We need to talk about the wealth transfer about to occur from Silicon Valley to Wall Street through the silver market. And we need to talk about how the $100 industrial floor is just the opening bid in a negotiation where all the cards are on one side. The trap has been set, but for the first time we are not the ones inside it. But to truly understand the scale of this betrayal, to grasp how deep the knife goes, we need to go back to the beginning. We need to travel back in time to the crime scene. Because this was not a plan Jamie Dimon cooked up over a martini last week. This was a master plan set in motion in the darkest days of the financial crisis. 17 years ago, the year was 2008. The month was March. The global financial system was melting down. And at the center of the blast zone was an investment bank called Bear Stearns. Most of you remember Bear Stearns as the first domino to fall. You remember the headlines, the panic, the stock collapsing from $100 to $2. But what history books usually leave out, and what holds the key to our current situation, is why Bear Stearns collapsed. They didn't fall because of subprime mortgages alone. They collapsed because they were the largest naked silver short in the world. Bear Stearns had established a massive, concentrated, short position on COMEX. We're talking about hundreds of millions of ounces of paper sold into the market. They were the whale suppressing prices during the early 2000s commodities bull market. But when silver began to rise in early 2008, that short position became a noose. Margin calls were choking them. Cash was bleeding out. And then the Federal Reserve stepped in. They arranged a shotgun wedding. They pushed J.P. Morgan to acquire Bear Stearns to prevent a systemic collapse. When J.P. Morgan walked into Bear Stearns' offices to inspect the books, they saw the toxic waste. They found the massive silver short position. A normal bank, one that actually cared about traditional risk management, would have closed it immediately, bought back the shorts, booked the loss, and moved on. That's what regulators expected. That's what the market expected. But Jamie Dimon is not a normal banker. He is a predator. He looked at that massive short position, roughly 200 million ounces of paper obligations, and didn't see a burden. He saw a weapon. He realized that owning the largest short position in the market gave him something more valuable than money: control. Control the short side and you control the ceiling. You decide how high the price is allowed to go. You become the captain of the ship. So instead of closing Bear Stearns as short, J.P. Morgan absorbed it, transferred it, fed it, integrated it into their trading desk, and thus began a 15-year con. For the next 15 years, J.P. Morgan used this inherited short position to execute the largest accumulation strategy in market history. The game was simple, brutal, and effective. Whenever silver prices began to rise, whenever retail investors got excited, whenever a new industrial use appeared, J.P. Morgan dumped massive paper leverage into the system, smashing the price. At 3 a.m. during thin liquidity, they would launch thousands of contracts into the market. They triggered hedge fund stop losses. They turned charts red. Do you remember those days? Waking up to silver being down $3 for no reason. That wasn't bad luck. That was an algorithm at work. That was the Bear Stearns weapon firing. But here's the turning point we missed. With one hand, they sold paper to crush the price, while with the other, they bought physical metal to fill their vaults. They were the buyer of last resort. When the price fell from $30 to $15, weak hands panicked and sold. Miners, desperate for cash flow, sold production at low prices, and who quietly collected every physical bar falling out of the market, waiting in the shadows. J.P. Morgan. They took control of the silver market like a distressed asset. They artificially distressed it, then bought their own crash. It's ruthless, technically illegal, but brilliant. They built a precious metal vault in London, expanded COMEX inventories, became the custodian of the SLV ETF, giving them legal access to retail silver and likely the ability to rehypothecate it for their own accumulation. Year by year, ounce by ounce, they drained the market. They turned paper liabilities into a physical fortress. A few years ago, they paid a $900 million fine for spoofing. Regulators patted themselves on the back. The media said justice was served, but to J.P. Morgan, $900 million wasn't a fine. It was a cost of doing business. If you pay $1 billion and make $50 billion, you run that trade every day of the week. And so the suppression machine ran flawlessly for 15 years. They kept prices low enough to discourage new mining, low enough to grind retail investors into boredom. Silver is a dead rock. It never moves. That was by design. They wanted it dead. They wanted it boring. Because if it were exciting, you would buy it. And what they didn't want was you owning it. They wanted it all. But every accumulation phase has a breaking point. Eventually, the vault fills up. Or more importantly, the fundamentals become so overwhelming that you can no longer hold the beach ball underwater. That moment arrived in 2025. Structural deficits we've discussed before, solar demand, EV demand, China, became impossible to ignore. J.P. Morgan realized the paper suppression game was over. Physical scarcity was becoming acute. Continuing to short into real scarcity risked an explosion, risked becoming the next Bear Stearns. So they pivoted, and that pivot is what changed the world. Based on the data we have, somewhere between June and October 2025, JP Morgan executed the final stage of their plan. They quietly and systematically closed the massive short position they had carried since 2008. They bought the paper back, went to zero, then went long. They flipped the entire book. They reclassified the 750 million ounces of physical silver they accumulated over 15 years. No longer a hedge. Now their primary speculative position. They moved from the short side of the balance sheet to the long side. Do you know what that means for price suppression? The entity that spent billions keeping prices low is now incentivized to spend billions pushing prices higher. The opposing force vanished. The wind is no longer in our face. It's at our backs. And not a breeze, a storm. That's why the price suddenly ran to $79. In the past, when we hit 75, JP Morgan stepped in and capped it. Today, they stepped aside. They let it run. They probably helped it. Because every $1 move in silver makes their 750 million ounce stockpile more valuable. Let's review the math. They likely accumulated this hoard over the last decade at an average cost around $20. Today the price is $79. That's a $59 gain per ounce. Multiply that by 750 million ounces, roughly $44 billion in profit, and that's just at 79. If silver goes to 100 to 200, we're talking about one of the most profitable trades in banking history. The dark, cynical beauty of their plan is this. They did it with our money. They used retail despair as cheap supply. They turned mining company distress into secured future supply. They damaged the industry for 15 years so they could feast for the next 50. So when you see the chart going vertical, don't think this is a meme stock rally. This is a JP Morgan release rally. The weight on the spring was removed. And the most terrifying part for the rest of the market, for industrial users like Tesla, is this. JP Morgan is now the gatekeeper. If Elon Musk wants silver, he can't go to COMEX. COMEX is empty. He has to go to the vault Jamie built. He has to knock on JP Morgan's door and ask for a price. And Jamie Dimon will smile at Elon Musk and say, "The price is the price I set, because the metal is mine, not yours." This is the path from market manipulation to market dominance. They suppress to own. Now they own to squeeze. The Bear Stearns legacy was not a curse for JP Morgan. It was the greatest gift they ever received. While everyone watched the stock market, it gave them cover to steal the world's silver supply. But now the lights are on, the vault doors are open, and we can see the pile. 750 million ounces. An unbelievable amount of metal. In the next part of this report, I want to examine what 750 million ounces truly means in the global market context. We need to compare it to mining supply, to deficits. Because when you put the numbers side by side, you see this. JP Morgan doesn't just have a big position. They have the nuclear launch codes for silver pricing. And they are about to enter the launch sequence. When you actually run the numbers on this 750 million ounce position, you begin to realize that what JP Morgan has done doesn't look like a trade. It looks like a hostile takeover of the periodic table. In the financial world, millions and billions fly around so often that we become numb to them. But in the physical world of commodities, geology has limits, and JP Morgan has pushed those limits to the breaking point. Let's start with the first and most terrifying fact: global mining supply. Every silver mine on Earth, from the primary mines in Mexico to copper byproduct mines in Chile to lead zinc operations in China, running 24 hours a day, 7 days a week, produces roughly 830 million ounces of silver per year. That is a hard ceiling. You cannot mine more ore than that. JP Morgan holds 750 million ounces. Do the math. That represents about 90% of humanity's entire annual silver production. Imagine a single company buying 90% of all the oil in the world in 1 year. or 90% of all the wheat. We would call that a monopoly. We would call it a national security threat. But because this is silver, and because it was done quietly over 15 years, no one noticed. They effectively privatized global supply. Now compare that hoard to the structural deficit. The world consumes roughly 1.2 billion ounces of silver per year, including investment demand. Mining only produces 830 million ounces. That leaves a yearly deficit of 200 to 250 million ounces. The market is desperately searching for silver to fill that gap. JP Morgan's hoard alone covers 3 to 4 years of that deficit. They are the only entity capable of filling the hole. If the world wants to keep the lights on, it has to cross the bridge Jamie Dimon built, and Jamie is charging a toll. But the most damning comparisons, the one that proves the game is rigged, is to look at COMEX inventories. COMEX is supposed to be the world's price discovery mechanism. The spot price is set there. Traders look at the registered category, metal, ready for delivery, to understand supply. Right now, registered inventory is around 30 million ounces, maybe 40 million on a good day. JP Morgan has 750 million ounces. That means JP Morgan holds 25 times more silver than exists in the entire public exchange system. Think about how absurd that is. The market believes there are only 30 million ounces available. Price is set based on that scarcity. Meanwhile, in the dark, a whale is sitting on 25 times that amount. This means COMEX is no longer meaningful. It's a flea on an elephant's back. The real market is in JP Morgan's vaults. And that brings us to the concept of float. In equities, float is the number of shares available for trading. When float dries up, stocks go parabolic. In silver, float is the amount of physical metal available for sale at current prices. By hoarding 750 million ounces, JP Morgan has effectively eliminated the float. This metal is not for sale. Not at $30, not at $50, and clearly not even at $79, because they're still holding it. They've taken this metal off the table, sterilized it. So when Apple wants silver for iPhones, it looks to the market and finds nothing. Mines are exhausted. Dealers are empty. The only remaining metal is in the hands of an entity that refuses to sell. This creates a super squeeze, not because silver ran out, but because it was privatized. The De Beers diamond model is being applied to silver. De Beers controls about 80% of diamond demand to keep prices high. JP Morgan now controls a massive portion of accessible silver supply. For what purpose? Repricing. And this is where the nuclear option enters the system. Because JP Morgan is now net long, they have a power no other entity can exercise, the power to withhold supply. If prices drop next week, JP Morgan doesn't have to sell. They close the vault door. If they refuse to release metal for just 1 month, the industrial supply chain collapses. Solar panel factories shut down within weeks. EV production lines stop. Panic reaches biblical levels. They have their hands around the throat of the global tech economy, and they know it. They can wait. They can wait for $100. They can wait for $200. Because demand grows every day, while mines age and ore grades decline. Time is on their side. For 15 years, they suppressed price to defeat time. Now they've flipped the equation. Time works for them. And you have to ask, why now? Why 2025? Why allow the news to leak when price hit $79? Because they needed a trigger, an external event to force prices higher without making them look like manipulators. They needed a villain, and they found the perfect one in the East. That brings us back to China. We talked before about export licenses. We talked about China locking the doors on January 1st, 2026. JP Morgan knew this was coming. Their intelligence networks are better than the CIA's. They knew China was about to squeeze global supply. So what did they do? They positioned themselves as the only alternative. When China cuts off silver flows to the West next week, Western industrial giants will panic. They'll search for metal. They'll see COMEX is empty. Mines are sold out. And then they'll face the only remaining stockpile on Earth. 750 million ounces stamped with JPM logos in New York and London. JP Morgan didn't just corner the market. They positioned themselves as the savior of Western industry. Need silver for Patriot missiles, Raytheon? It's available, at a price. Need silver for Tesla's Elon? It's available. Price is price. They've engineered a scenario where they can extract maximum value from the U.S. economy while blaming China. A flawless geopolitical move. The math is visible. 750 million ounces versus a 200 million ounce deficit. 25 times COMEX inventory, 90% of global production. These numbers don't lie. They tell you the free silver market is over. We're now inside a monopoly market run by the House of Morgan. For the retail investor, this is the most critical inflection point of your life. You hold the same asset the monopolist holds. Every ounce you own is an ounce JP Morgan doesn't control. Every ounce in your safe is a share in this repricing. They want higher prices. You want higher prices. For the first time in history, you are aligned with the bank, but there are victims. Real producers are victims. Time-dependent manufacturers are victims, because time has slammed into the wall of JP Morgan owns everything. In the next section, we'll talk about how this becomes a trap for Tesla and Apple. When Chinese supply shuts off and they turn to the West, they'll discover the West is one bank, and that bank is wide open at a very high price. The industrial victim is about to be skinned. And that brings us to the question every detective asks at the crime scene: why now? Why did JP Morgan close the short position they nurtured for 15 years at the end of 2025? Why press the button now? Not out of conscience, out of calendar. They looked at January 1st, 2026. They saw the external trigger. Banks don't trade charts. They trade information asymmetry. They know laws written in Beijing before the ink dries. In early 2025, the message from Shanghai analysts to New York was simple: China is locking the door. Not a bureaucratic tweak, a strategic system to protect Chinese housing and solar sectors at the West's expense. JP Morgan saw two options. A, stay short, get annihilated by China-driven demand shock, end up like Bear Stearns. B, own everything not nailed down before the ban, wait for panic. They chose B. Over the last 6 months, they drained COMEX, ETFs, and private stockpiles. They had to secure 750 million ounces before January 1st, because after January 1st, price wouldn't be set by paper, but by desperation. This is a military pincer move. China cuts demand in the East. JP Morgan cuts supply in the West. The free market is crushed in between. Politically enemies, financially squeeze partners, and the squeeze starts next week. JP Morgan won't open the tap. They'll keep vaults shut to let panic grow. When Tesla calls, they'll say, call us next week. Price is rising. They'll blame China and collect the money. 750 million ounces is not a trade. It's a strategic reserve. America's privatized silver reserve. If the Pentagon needs silver, they knock on Jamie Dimon's door. That grants JP Morgan immunity. For investors, the conclusion is clear. JPM will walk this rocket into triple-digit prices, but the real blood will show in tech. Without hardware, software is nothing. Hardware is made of silver. Silver belongs to the bank. Next, we'll examine Tesla, Apple, and green energy one by one. We'll see that Elon Musk's "this is not good" tweet was the understatement of the century. Tech giants are the prey. JP Morgan is the predator. China is the terrain. Let's watch how the hunt ends. And that brings us to the kill zone. We've identified the predator, JP Morgan, with its 750 million ounce hoard. We've identified the terrain, a demand squeeze engineered by the China export ban. Now we examine the prey. Because the real target of this 15-year trap isn't retail investors. It isn't gold bugs. It's the entire Western technology and green energy sector. We're watching the setup for the greatest wealth transfer in history, not just from poor to rich, but from Silicon Valley to Wall Street, from those who write code to those who own atoms. And the face of the victim is the man who just realized he's walking into a buzzsaw, Elon Musk. Think about the business model of the last 20 years, the tech boom. It was built on a simple, arrogant assumption. Hardware is cheap. Software is expensive. Companies like Apple, Tesla, and Samsung built trillion-dollar empires, assuming raw materials were infinite and disposable. They assumed silver, lithium, and copper would always be available at rock-bottom prices, suppressed by banking manipulation. They treated the periodic table like a grocery store that never closes and never raises prices. They built just-in-time supply chains. They held zero inventory. They mocked stockpiling. Why buy silver today, they said. We can buy it tomorrow on COMEX at the same price. They became addicted to suppression, the manipulation that crushed miners, subsidized Silicon Valley. JP Morgan subsidized every iPhone and every Tesla by keeping silver artificially cheap. But traps don't stay open forever. You let the animal relax. You let it eat the bait. You let it build gigafactories and solar plants. You wait until trillions in infrastructure can't function without silver. Then you snap the trap shut. That's what happened this week. When China announced the January 1st export ban, JP Morgan revealed its 750 million-ounce hoard. The trap closed. Just in time died. It was replaced by not at any price. Elon Musk's "This is not good" tweet was the sound of prey realizing the cage door locked. He wasn't looking at charts. He was looking at his 2020 to 2026 production schedule. He knows he needs 50 million ounces of silver. He looks east. China says no license. West, COMEX empty. Mines sold out. One phone number left, Jamie Dimon. And that's where negotiation begins. That's where the wealth transfer happens. Imagine the call. Elon, I need 50 million ounces to keep Austin running. Jamie looks at his vault, looks at 750 million ounces, knows he's the only seller. Does he sell at $79? Absolutely not. Market's tight, Elon. China's closed. Premium, $150 an ounce. Elon has no choice. Pay or factory stop. Stock crashes, empire crumbles. So he pays. Billions flow from Tesla's balance sheet to JP Morgan's. The tech premium evaporates. The physical premium takes over. This is the revenge of the old economy. For 20 years, banks were boring, miners were dead money, tech was king. Now those who own physical reality charge rent to those living in digital fantasy, and rent is due immediately. And it's not just Tesla, it's the entire green energy transition. Net zero mandates were written assuming silver stayed $20. Cheap inputs. Bad math. Solar is cheaper than coal if silver is manipulated. What if silver goes to fair value? $150, $200. Solar isn't cheap anymore. The green revolution triples in cost overnight. The math breaks. Who holds the keys to saving it? JP Morgan. Governments will come begging. Please, sell silver for our climate goals. Jamie smiles. Price is price. Taxpayer money flows into the vault. This is why it's called the industrial victim. Companies and governments are hostages, lured into dependence on a scarce metal, now squeezed by its owner. A classic 19th century corner. Vanderbilt railroads, Rockefeller oil, JP Morgan conductivity. The tragedy? They could have stopped it. Tesla and Apple had the cash. They could have bought mines, secured supply. They didn't. Arrogance. Now watch next week's price action. Panic buying. Strategic hoarding. Samsung buying for next year, not next week. Feedback loop. Panic drives price. Rising price increases JPM's hoard value. Reducing incentive to sell. Why sell at $80 when $100 is coming? That's why the industrial floor is solid, not speculators, desperate treasurers. If price dips to $70, Tesla must buy. Apple must buy. JP Morgan knows it. They'll manage the squeeze, walking it up. $85, $90, $100, $120. bleeding the patient without killing it. Atoms now rule bits. Where are you? Sitting at the atoms table, holding physical silver aligns you with the predator class. Tesla needs your silver. Samsung too. When they come, you name the price. One final piece, currency. While JPM squeezes industry for dollars, the dollar is dying. Repo spikes. Money printing. JPM isn't just long silver. Shh, they're short the dollar. 750 million ounces isn't a trade, it's a lifeboat. They swapped fake money for real money. Now they let fake money burn. $100 isn't just a squeeze target. It's a monetary reset. If the dollar loses 20 to 30%, silver rises because the denominator collapses. JP Morgan profits at every step. Arsonists who bought fire insurance. 750 million ounces is the policy. The plan? Expect a fake smash. Watch premiums. Watch Shanghai spreads. Watch industrial panic. Sell? For what? Trading real assets for dying currency is suicide. Silver is only sold for other real assets. An era ends. Paper died. Just-in-time died. Trust in banks died. The real era begins. Those who hold atoms make the rules. JP Morgan has 750 million ounces. You have your stack. Same table. This price goes triple-digit not on hope, but on geology and greed. Thank you for watching Finance Land. For more content like this, don't forget to like the video, subscribe to our channel, and share. History holds the answers.